Good afternoon. This is Peter Kim from Withum and my co-host Jonathan Almeida and two panelists coming to you live from New York City. I'm in my office today, which is very strange considering that I haven't been in for many months. So welcome everyone. We wanted to welcome you to our third segment of our roundtable discussions. Today's topic will be on financial institutions AML KYC challenges associated with correspondent banking, part two. Today's agenda. Today we will go through the housekeeping rules. We'll do introductions, introduce you to our esteemed panelists. We had a switch from the last session. Mark was not able to join us for this session, so we invited back Kevin Choi by popular demand, who was one of the panelists from the original session. And we'll go through the agenda topic points, closing questions from the audience, as well as a number of closeout points that we want to close with. And next page. So myself, I am Peter Kim. I'm a principal with Withum over at the Forensic and Evaluation Services Group. I have almost 3 decades of financial services experience, half of that in regulatory compliance in various forms for BSA AML, where I served as BSA officer, examiner for the Fed, and also other consulting firms as well. And I'm happy to join you as part of our esteemed group of professionals, bringing really a good session to you today.
And my name is Jonathan Almeida. I'm one of the co-founders of AML Partners. We're a software development company. The name of our solution is, as you can see there, it's called RegTech One. It's a workflow engine. Primary use design of the application is with a no-code in mind. So it's a no-code platform solution. Thank you for joining us. Appreciate it.
Hey everyone, I'm Bill Radin. So I am the Executive Director of Legal and Compliance over at ICBC, the Industrial Commercial Bank of China, for those that don't know the abbreviation. I'm also their BSA officer, and I have responsibility for the sanctions program as well. It pains me to say this, but I have almost 20 years experience in the financial crimes compliance space, and I have specialized in many global financial institutions that have been under enforcement action.
Hi everyone, my name is Kevin Choi. I'm happy to be pinch hitting today for Mark, and glad that you guys invited me back after that first session we had. I am the Deputy BSA Officer for Sumitomo Mitsui Banking Corp New York branch, also known as SMBC. Similar to Bill, I've been in compliance for about 20 years, also the Chief Compliance Officer, BSA Officer at Israel Discount Bank, as well as some other local banks here in the New York area. And also was a regulator for the Federal Reserve Bank.
A couple of disclaimers to get out of the way. We wanted to inform everyone on the call that contents and statements made in this event are strictly the opinions of individual participants. It does not represent our firms and associated entities. Contents and statements made at this event are not recommendations or intended as guidance on regulatory requirements. And this is appropriate given that a number of us are former regulators for major organizations.
Great, and we are also going to do our first poll right now. There will be 4 polls throughout this program. We do need you to vote for each one in order to get CPE credit. Our first question is, regulatory expectations on AML program has gotten harder, not easier, during the COVID-19 pandemic. True or false? We are at about 75% of people voting right now.
And also to get CPE credits for this session, CPE questions must be answered. So I would really appreciate it if everyone took the time to answer the questions. Thanks.
And we are going to close this up in a moment if you can get in your final selections there. All right. So as you can see, most people here say true.
No surprise there.
Okay, so agenda topics, we'll get to it. Just a few words, if you don't mind. I just wanted to share with everyone how grateful that we are with your participation in this event. It is truly interactive. I think part of the success that we had in the series of conversations, the interactiveness of not only the panelists to the host, but also the audience participation as well. I know that we have enjoyed and had great times answering questions that are coming from the audience. So if you can, please use the chat box to pose questions to the panelists so that we could make this even a better session than it can be. And also having been part of many sessions at other institutions and other forums, what we try to do is make this a little bit more personal. And we are professionals in this space, and also the panelists are experts in their field. So we try to do this in a different way so that it's not so dry and as scripted as much. So with that, we'd like to go into some definitions and background for the session so that we could get these out of the way. So definition for correspondent banking. Correspondent banking refers to a financial institution that provides a service to another, usually in another country and used in cross-border transactions and transfers. It acts as an intermediary or agent, facilitating wire transfers, conducting business transactions, accepting deposits, and gathering documents on behalf of another bank. And nested accounts. Nested accounts involve foreign banks or institutions that have access to U.S. investments and assets through another foreign financial institution accounts with U.S. banks. And the difficulty for all of us, and as I remember personally, is that it's very difficult to see accounts within accounts, which makes KYC and EDD that much more of a challenge. Next page.
I'll take these two. RMA, Relationship Management Application. RMA is essentially a service provided by SWIFT to manage the business relationships between financial institutions. RMA operates by managing which message types are permitted to be exchanged between users of a SWIFT service. Conversely, the receiver specifies which message types are permitted. One of the main reasons why we're going to be, we thought we'd bring the definitions and state the definitions right at the very onset, so some of the panelists wouldn't have to have the need to sort of explain what these terms are. And finally, to close, trade finance. Trade finance represents the financial instruments and products that are used by companies to facilitate international trade and commerce. Trade finance makes it possible and easier for importers and exporters to transact business through trade. Trade finance is an umbrella term, meaning it covers many financial products that banks and companies utilize to make trade transactions feasible.
Thanks, Jonathan. So definition and background. So why are we here? Why are we talking about correspondent banking? So as many of us have experienced on different sides of the table, correspondent banking is a very hot topic for compliance officers. And if you're on the other side of the regulators, this is a topic that becomes a discussion point for examination, review, and sometimes criticism from the regulators. And having sat on both sides of the fence, I know that this is a complicated bit of business, which not everyone gets right. And not only gets right, sometimes you are experiencing various interpretations and engagement with the federal regulators. So there isn't a unique and standard way of approaching how to get the correspondent banking compliance right. And to that, there has been some recent regulatory examination supervisory actions involving correspondent banking. So 3 cases to note, which involved public actions against institutions involving correspondent banking. One was Mitsubishi Union Bank in 2019. The other one was Dzogchen in 2017, which mentioned CDD and transaction monitoring deficiencies involving correspondent banking. And the last one was Mega International Commerce Bank, where my friend and colleagues, Peter Chang and Dave Hazen, were at back in 2016, were cited for correspondent banking, and specifically they mentioned business and AML role conflict, where there were business folks that were functioning in the AML side, so that they called that out. Program deficiencies, customer due diligence and AML program designs, and transaction monitoring issues in relations to correspondent banking. Next slide, please.
Great. We're actually just going to do a quick poll again. Prior exams or audits negatively commented or criticized your bank's correspondent banking compliance program. True or false? Okay. We're at about 70% of people completing. We're going to look to close this up shortly if you could get your votes in. Okay. So about 60% of people had said true.
Great, then I guess we have the right forms for this group. So wanted to talk about what we discussed last time on part one of the correspondent banking roundtable discussion. So as a short recap, in the last session, we talked through the challenges posed by correspondent banking compliance and the ultimate beneficial owner information, which is very difficult to gather, being that there are multiple parties and they sometimes may be customer of a customer and serving that level. The other topics we talked about were successful risk mitigation efforts associated with correspondent banking, and Mark and Bill did a great job with that. Dealing with regulators regarding correspondent banking. We talked about personal experiences and also some takeaways from there. And correspondent banking in relations to enhanced due diligence, transaction monitoring, and other activities that compliance departments had experience with correspondent banking and KYC. So using that as a springboard to today's session, we wanted to engage Kevin and Bill to additional questions and topics surrounding correspondent banking. And with that, let's go to the next page.
Before we do that, real quick, we're going to just do one more poll as to not interrupt the discussion coming up. Current compliance budget levels at your institution are satisfactory, adequate, needs improvement. And a good mix of responses thus far.
And just for the record, the information and the answers are anonymous, so no need to be concerned. I just wanted to share that.
And we're at about 72% of people. We're going to close this out shortly if you could get those last minute responses in. Okay. And here are those results.
Interesting split, but majority of the responders stated that it needs improvement. Actually, it needs improvement 38. Adequate. That's surprising. Okay, I always figured with the pandemic and the slowdown, there might be a higher number for it needs improvement. Okay, so to lead this session, and I'm going to ask for the panelists to take turns answering the question, followed by one another. Bill, if you don't mind, if I could ask the same question, first question to you, and we'll go from there. So the first topic or question: how can a financial institution right-size the correspondent banking risk through minimizing risk to match the risk appetite of the institution?
That's a great question, and that really that's kind of a, I would say, a question of identity. Who is your bank? Your bank has to decide what its risk appetite is first before you begin to manage to it. Certain recommendations here is to look at geographic regions which the bank intends to focus on and are key and strategic for their business model. Anytime that a bank is entering into a new geographic region, that probably should raise a risk assessment or a new product risk assessment, a reevaluation of your foreign correspondent banking services. So I think that part of effectively managing to a risk appetite is, number one, defining your risk appetite. Number two, having a robust risk assessment process that identifies all the risk that's coming through your foreign correspondent banking network and appropriately maps that risk out. And then also on the customer risk rating and due diligence front, performing risk-based due diligence that highlights the key risks that are associated with each of your customer base. And I think that that's one of the reasons why financial institutions have typically afforded a high risk rating or to their foreign correspondent accounts, to ensure that there's an adequate level of due diligence, because simply the regulatory prescription is to have enhanced due diligence on your foreign correspondent relationships or something more than due diligence. But many institutions have opted to make them high risk to afford the level of scrutiny and approval that come with high risk accounts. High risk customers typically go to a management level approval. So you have people that are charged with setting the risk appetite of the institution, evaluating the relationships. So that's just some tips, but it's a very broad topic.
Fantastic. Kevin?
Yeah, I agree with everything Bill just said. I think we're going to be talking more about this question and answering this question throughout the session. So yes, you must set what your minimum risk appetite is for your bank. I mean, what kind of geography, what kind of products and services that you're going to be comfortable with. Are you really going to open a correspondent banking relationship in Venezuela right now or Crimea? Things like that. So the OFAC issues come into play as well. And then after that, you need to assess, what are the risks of your relationships or correspondent banking relationships, and match that up and see if that kind of fits into your, what your established appetite is.
Thanks, Kevin. So the next question, and thank you for the definition before, Jonathan. So RMAs, as many of us know, they're not directly our clients, but they are relationships that are not clients. So in looking at that relationship, what's your approach for addressing the KYC requirements for RMAs? Kevin, if you could start us off.
Yeah, this is an issue that comes up very often, unfortunately, and many banks are struggling to deal with it because there's really hasn't been very good guidance from the regulators. I gotta say, but my personal opinion, for an RMA, Swift key exchange, they're not your customers. It's just a relationship that you build through the Swift network so that you can exchange some sort of information, not payment information, but certain information that doesn't really constitute a definition of a customer under BSA. So as such, we get a lot of requests. I think most of you guys have seen this coming in from foreign banks saying, oh, because you're a customer of ours, we need to do KYC. And as a result, please provide us with beneficial ownership, directors, IDs, banking license. I've seen as much as AML program, internal audits, exam reports, things of that nature. My recommendation to this is just have a standard response that says, because of these reasons, we do not consider this a correspondent relationship or respondent. We're not a respondent of your bank. And you can refer to our completed CBDDQ or FCCQ, whatever that applies to you, and just say this is what you get. And if they really, I've had banks come back and say, no, this is required by our regulation, blah, blah, blah. And then they say, just respectfully go back and say, please provide us with that regulation, and then we'll address it going forward. But every time I've gone back, I haven't gotten anything from those countries. So I think that's a pretty sound advice. I don't know if you've seen anything else, Bill, on your end.
I will say I think that this is something that there are disparate compliance approaches within the market, which has been very interesting to me as a compliance professional, but a source of grief to me as a BSA officer. Anytime you have an inconsistent market standard, it's kind of a challenge, because the regulators sometimes benchmark your institution against what the market is doing. But my approach to this is I go right to the letter of the law. I mean, it's not a customer under the BSA. There is no formal relationship for the provision of financial services as typically memorialized by an account. So this is simply the exchange of messaging information. It's not the provision of a financial service. So I don't believe that it satisfies the regulatory definition. I would mark to say that most banks and most AML attorneys are probably within agreement with me. And as that approach, typically the risk mitigation techniques that we take towards the RMAs is really fundamentally screening, much the same as you would do with a vendor or anybody with which you have established a relationship. So you would subject them to ongoing screening, but nothing beyond that.
Thanks, Bill. Go ahead, Kevin.
I just want to throw in an additional question. So do you then sort of bring these RMAs and onboard them? Granted, that's limited information that you're collecting. Do you also then onboard them within your KYC solution, or do you sort of isolate them in a separate system onto its own?
Well, see, that depends on the institution. It's how you affect your screening. I mean, certain institutions will not necessarily onboard them. They'll identify them, flag them as a counterparty. Like there's certain systems have a status that's called non-customer counterparty. Or they could just put them as part of their badge screening that with names of interested parties, or with your vendors. I mean, theoretically, you have ongoing screening of your vendors and your employees as well. So similarly, feeding them into your negative news sanction screening system. So it doesn't necessarily require a full onboarding. Some banks may venture to perform CIP in the off chance that there's a match, but I don't think that you really need to be, from a risk-based approach, you don't need to be doing CIP on these entities. They're readily verifiable financial institutions. There's no question of who these entities are.
Excellent. So Bill, I'm going to stick with you and go to the next question. This is something that's personally painful for me, because I had experience with institutions where the vendor solution for mitigating the correspondent bank risks, there really isn't a standard way or an effective way of mitigating the risks for CBR. And based on that, much expenditure and a painful process of looking at different vendors was engaged. So if you don't mind, what are some of the ways that you've seen that the vendors approach the minimizing of the correspondent banking risks from a BSA AML perspectives? Because I really feel that this isn't a very good solution that's out there that anyone's been able to crack.
And that's very true. And I think that's been one of the pain points for most AML transaction monitoring spaces, most certainly, is that nobody has really come up with an AML transaction monitoring automated solution that effectively addresses every risk afforded to correspondent banking. Certainly, there are correspondent banking rule sets that operate in AML transaction monitoring systems, and a lot of these that vendors provide. And part of the challenges that are not necessarily addressed through AML TM systems have to do with topics that we're going to discuss more in depth later in this presentation. But for example, nested activity. There is no hard fast rule for the detection of nested activity. There are rules that look to jurisdictional risk or number of banks that may potentially detect nested activity, but they weren't constructed with that in mind. Similarly, if you look to trade finance transactions, it's a documentary business. There's no way to have an automated solution around trade finance, the processing of trade finance transactions. So there is that noted challenge. And what I have seen is that banks have turned to both an automated, a systematic, as well as a manual approach, doing a deep dive into due diligence to help bridge that gap from what the automated systems can do. Also, I will say on a side, something else that is very valuable that is out there in the vendor space is a number of vendors will provide analytics solutions that could give you better insight into country risk and into building out networks between your SAR subjects and the banks that they use. Now, a few vendors have offered these types of solutions, and I do think, depending upon your risk profile, they may prove to be valuable. I know most certainly in the past I have used them when we were working with very high-profile investigations or investigations that led to enforcement, or if we have a very strong presence in an emerging market and wanting to understand all the intrinsic risks of banking that market and that customer type. So I would say that the greatest value is in this analytics space, but analytics is very much in its infancy. And there are some vendors, I don't know if there's somebody out there that's 100% foolproof and better yet, regulator tested. There's yet to be one that really has that regulatory seal of approval.
Yeah, I agree. Transaction monitoring for correspondent banking is tough. I know that at my former bank, we had to create our own because the vendor did not provide that, and the vendor actually ended up using our scenario and started selling that as part of the package. And we're kind of doing that right now, currently, creating a scenario precisely for nested transactions, because again, as Bill mentioned, there is really nothing out there that's very good. So unfortunately, I hate to say it, you're kind of stuck creating or hiring another vendor to kind of specialize this thing that fits what your bank's profile is. It is what it is in the current world, AML world. I mean, a couple of other things that outside of transaction monitoring that you can use, that we use, is reaching out to, subscribing to like Banker's Almanac or Swift KYC registry to pull a lot of the due diligence information that that kind of saves you that time reaching out to these individual banks. I mean, if you have a handful of relationships, it's not as big of a deal, but once you get it to hundreds and hundreds, then a service like this would really help you. And something else, this is just part of your regular due diligence of all your customers is, negative news screening, PEP screening. You can just have some sort of an API pull from a vendor that'll kind of regularly do this, because the expectation from the regulators is that you do this a lot more frequently than your regular customers.
Yeah, I think those are really good points you bring up. Also, with respect to Banker's Almanac, is that part of your regular customer due diligence on banks? Because that most certainly, in my experience, we've adopted the Banker's Almanac as part of our due diligence, our enhanced due diligence that we do on our FCAs, on our foreign correspondent accounts. So, is that something that you use as well, Kevin? Is that part of your due diligence on correspondence?
Yes.
So is that generally used at the time of onboarding and at the time of periodic review? Because that's okay. So those are the two.
That's correct.
Those are the 2 points that you did. Gotcha. What about corporates? I know most of it revolves around just the correspondent banking. But what about corporates? Is there a source for pulling in corporate data as well that you guys utilize, or is that
not like a Banker's Almanac, unfortunately? I mean, that's on a case by case.
Gotcha.
Yeah, it's a case by case. I mean, there are some analytics and vendor service providers that offer a database that has a repository of global equivalents of our Secretary of State or registries that have global business registries. But the market, they're not really well tailored to the markets that present the most risk, and those markets present risk because they're not transparent. So I mean, it'd be one thing to have a repository of all U.S. entities, which I think our Congress is moving towards, which would be really nice. But, you know, it's baby steps. And I don't think that the countries that introduce that level of risk are necessarily the ones that are going to afford you the transparency or are going to have those regulatory filings that you need to see in order to understand ownership.
Apologies, Peter. I went off script here. Once again, talked about corporates, but this is supposed to be on correspondent banking relationships. My apologies.
No, I think this is what we dialed in for. This is the value added part of our forum, because it does allow us to take this in different ways that it's going to take. So this is perfect. So the other question, I'm going to go back to Kevin on this, is how do you control the imperfect information from the non-customer institutions for correspondent banking activity? I know that Swift messages can come in different sizes and shapes, and there's a lot of issues with that.
Yeah, so great question. Unfortunately, you can't control that data. You know, what you can do is try to kind of tune your system to be able to, you know, have reasonable controls, right? To see what you can do about this. So, for example, a missing country that comes in, you know, does that affect some of your scenarios in transaction monitoring? And if it does, you know, it's supposed to raise the score or lower the score or whatever based on the country information. You know, you need to make sure that your system has enough controls to kind of see that missing information and react to it, right? I mean, because it also affects not only transaction monitoring, but your sanction screening system as well. So, you know, can you reach out to your customers and ask them to fix the information coming in? I mean, you can. You know, is that going to really have an impact on what you're getting from your customer? Most likely not, unless your correspondents are your affiliates. I think in that case, you know, for us, we have a lot of affiliates that are our customers. I think you can have a conversation, you know, with the head office or whatever to kind of come up with this kind of data issue, right? I mean, the other thing I think you need to focus on is kind of the end-to-end data validation that you might be doing as part of your, for those banks in New York, you know, 504 validation or model validation of your systems. I think that's kind of going to discover and kind of show you where the bad data might be coming in. And if it does come in, you know, how does it flow through your system and how does it affect all of your downstream processes?
Yeah, so just to build upon what you said, I do think that nowadays transaction monitoring systems are sophisticated enough that there is some level of fuzzy logic and fuzzy matching that can be applied to help correct certain imperfect data, but there also has to be risk decisions made, such as in the event that a data field, most usually a jurisdictional field, is left blank, that defaults to the highest risk. So that way it drives the likelihood that it will alert, because it's just, it becomes kind of a risk tolerance and a risk acceptance scenario as you're creating and tuning your rules. But yes, I have benefited from fuzzy logic, certain fuzzy logic in our system. Also, in the past too, we have done targeted reviews to understand any issues with respect to misuse of MT202s. So I have dealt with in the past with certain financial institutions that have misused 202s, and we were able to target that through an analytics process in-house and end up sending a warning, and then for further failure to comply, a de-risking of that financial institution. But also, this point here is obviously broader than AML detection. Like Kevin said, there is the sanctions nexus as well as a travel rule violation. So there certainly are other implications here. So it's hard to police, but we can do it to some extent systematically.
Yeah, and one other thing I might add is truncation of information. I mean, as you know, some of the fields can get truncated or added to the next field within the message. So I mean, I think, you know, something else that you need to look out for is make sure that your sanctions filtering system has a rule that's designed to kind of, you know, watch for the truncation and add those fields together to sanction effectively, filter effectively.
Kevin, have you seen sort of address data enhanced in any way? So if you're not finding a country, it's one thing to have your AML monitoring system sort of detect when there's a missing country to elevate that, right, and get you to notice them. But is there, have you seen, or has there, or are you aware of addresses where missing country, where an address is populated and dropped in there based on the address information, the city perhaps?
Yes, I have, but you have to be very careful, because if it doesn't work well and it's spitting out something that's completely wrong, I mean, you're double screwed. So I think that's kind of the hesitancy with these, what you're fixing, because you really, and then once you fix that, you got to make sure that that information doesn't get into some other system that may affect something else. So it's, yes, I've seen attempts at it, but it's nothing that really worked perfectly, if I can say that. Yeah.
It's a damned if you do and damned if you don't. Yeah.
Yeah, but most certainly, well, you're also damned if you do under DFS 504, because you need to ensure your data lineage is fuzzy matching. So there has to be a lot of testing that goes into any risk acceptance or any threshold setting that you have for your fuzzy logic. So I definitely think that this is the way forward. It is the way forward, but before you implement and make these kind of decisions, you better have extensive detection and understanding of what's productive and what's not, and also recognize the worst thing an institution can do, and this is the genesis of some enforcement actions, is this is a potential red flag for payment stripping. I mean, that if you don't necessarily have the country in the payment, that could possibly equal into payment stripping. And that is something that if you manage that risk wrong, you are really up the creek. I mean, so I think it's something that we have to be very sensitive to, and there's a lot of scrutiny on because of DFS 504.
Absolutely right, Bill. I mean, with some of the smaller foreign bank branches with low limited volume, maybe that's manageable, but you're right. Some of these larger institutions with, tens of thousands of records, who's going to manage this, or who's going to notice this on a daily basis, right?
Yeah, and it's one thing if it's, US addresses that you have to fix, but when you have foreign addresses for which, it could be anything. I mean, how do you even start there, right? And it becomes very, very difficult and challenging.
Yeah, and then you guys mentioned different ways to mitigate some of this, talking nicely and leaning on some of the affiliates. What are the methods you have at your disposal that you had utilized to get them to do the right thing?
Sorry, Peter, you got cut off there.
I mean, I can jump in a little bit on. I'll jump in first because you mentioned talking nicely, but what is it? What was it that Teddy Roosevelt said? That walk softly but carry a big stick. I mean, the idea is that you can talk nicely, but understand that a failure to comply will result in de-risking, and it will be the cessation of providing financial services. So obviously, in egregious cases where you have a continuous misuse of MT202, you would consider de-risking. Now, in cases where you have an affiliate that does not comply, that will not comply, first off, I think your first step is, if you are a global institution, you go to your group, you go to your head office, and try to establish a head office standard. Because I think that that's one of the challenges too in these global institutions, is that the branches and affiliates in the global network are responsive to the global policy. So yes, you can always threaten to de-risk an affiliate, which would cause a lot of grief politically, but it has been done, and I have done it personally. But you really should start from the top and take it to head office level and try to adopt it in your firm's policy as to what the appropriate formatting for your payments is.
Yeah, I mean, I do agree. I think something else that needs to happen, unfortunately, is training. Training, of your correspondent bank customers, and have them understand what our minimum expectations are, and almost like setting up an SLA with them to say that, if we ask you a question, you need to get back to us by a certain date, and have that, line of communication, standard line of communication, and that escalation process. If the terms of the SLA are not met. So it's not an easy conversation, obviously, right? Depending on how big the customer is and how significant that relationship is for the head office. But I mean, you need to demonstrate that, because that's what the regulators would kind of expect, right? Because I mean, there's this customer that's just not listening to you and continues to kind of, go afoul, and what are you doing about it? It's like, nothing. That's not a good enough answer.
Yeah, exactly. And that's one of the points I brought up in the last meeting too, in our last conference, where I talked about RFIs. I said that our RFIs need to manage expectations and have teeth. Anytime you're sending a request for for information or requiring a response, you have to assign a period of time to which that response for them to respond to. So typically it's like 10, 30 days. But you assign that period of time, and then you do something if they don't respond. And that do something might include filtering their transactions.
Okay. I'll take this one. What is the industry standard, if there is an industry standard? Well, what is the industry standard for addressing risks of downstream correspondent banking relationships and nested relationships? I think, Bill, you started to answer a part of the nesting part of it in the last one, so maybe you could take your thoughts if you have any, if you haven't already disposed of them in the previous one.
So this has recently become one of my favorite topics: is nested, what to do about nested activity. I mean, clearly, nested activity is risky. It's part of the inherent risk of correspondent banking services. And however, it's not prohibited. It's certainly not prohibited by U.S. regulation, and by, I would say, most certainly the foreign market. It's kind of it's kind of practice. So, but it's not necessarily best practice. Now, what needs to be done first is your bank needs to establish what is their position on nested activity. Are you simply not going to permit it? Are you going to take a policy decision, say that nested transactions are not permitted through your bank? And if so, develop a policy that states that clearly that's your risk appetite. Train on it, and you have to train on what is acceptable downstream transactions versus what is nested. For example, you will have some foreign banks will clear for their domestic branches. Is that acceptable within your policy, or is it not? I mean, to have to understand how your branch network processes payment. So there, I think first you have to establish what your appetite is, write it down, socialize it, and then begin to police it. And policing it is very difficult on the automated front. So from an AML transaction monitoring front, there, as I said earlier, there aren't rules that are calibrated to detect nested activity. I mean, it's something that some banks have taken on and developed their own proprietary solutions. But for the most part, you do kind of back end into detecting it through your rules. You will detect it through potentially your high-risk jurisdiction rules, your banking outside of jurisdiction, or your keyword rules. Or alternatively, when you perform your periodic reviews on your foreign correspondent accounts and conduct a transaction analysis, you might see it as well. And that's really the time to call it out. So, and it also should be detected as part of your questioning of your foreign correspondent relationships, as part of your enhanced due diligence. You should flat out ask them, do they provide downstream correspondent banking services? If so, who are those banks? Or are they branches, affiliates? Who are they? And then at that time, if they're honest with you, you can assess whether that's some kind of risk you want to take on.
Yeah, so unfortunately, there's really no standard for nested, downstream activity. Everyone kind of does their own things. But yeah, I think, I do agree. Transaction monitoring is tough. You do a lot of this due diligence through your periodic review process or at onboarding. The CBDDQ does have a section on downstream activity. So it will say, do you offer downstream to your customers, blah, blah, blah. I think as you're going through reviewing the questionnaire, once you do notice that there is that component, right, the high risk component, then, a lot of banks, what they do is they kind of send additional questions. They may have a nested customer questionnaire, where they kind of talk about the details of their customers. What kind of customers do you have? Who are they? Do they themselves engage in high risk activity like MSVs and marijuana, things like that, cryptocurrency. So, I think holistically, you kind of have to take all of that information together and then assess, if you're comfortable continuing to do that business with your customer based on the information that you got. Also, the customer may not disclose it to you as part of the CBDDQ. It happens all the time. But as part of your transaction monitoring, your analyst will see that this looks like a nested activity. There's another bank involved at the end, and then another customer of that bank. In that case, there has to be some sort of communication between the transaction monitoring team and the KYC team, so that your KYC records are updated to reflect that. And at that point, you have to go back to the customer and say, hey, ABC Bank, you responded no to this questionnaire, but we're seeing transactions that speak otherwise. Explain that to us. And if they can't explain it to you, then you need to consider, does this kind of raise that risk level above what you're willing to accept?
Yeah, I think that's very important too. So I agree with you, Kevin, that we need that. You need to have that feedback loop, because that's fundamentally part of your. Periodic review is a good time to detect it. But if your AML team sees it, they should say something, because it should trigger an event-driven review. But if you do see it upon your periodic review, that's part of why you're supposed to assess anticipated versus actual activity. So this is your opportunity to hold that bank's, ABC Bank, to account to their representations and decide whether they really should be your customer. So I totally agree with you, and I do believe in that customized questionnaire for when a bank presents heightened risk factors.
And by the way, I didn't mean to say ABC as an agricultural bank of China, just to make that very clear.
I wasn't judging.
Kevin, I've got just on the EDD side for that nested questionnaire. If you request, then who are their customers, their major customers? Do you then take that information and do something with it, like put them through a negative news screen or things like that, or add them to your list of clients that are screened?
Yeah, you can do a number of things. You can definitely do your own due diligence, but it's got to be risk based, right? Because if they've already disclosed that to you on the CBDDQ that they're doing this, and you know what they're doing, these are kind of their affiliates, branches, do you really run all that through negative screening and use up your resources? No. But, if these are kind of undisclosed and it's like brand new and they're in a high risk area, then I think it behooves you to kind of take that extra step.
Gotcha. Great. Peter, can we do the next few? I know we're running short on time. Should we continue with the next 3 bullet points, or?
Well, I think we should choose one of the 3. Take the best one, and maybe the panelists can pick from the remaining 3.
Maybe the last one's a little dicey.
Yeah.
That's the one we should go for, right?
Yeah.
All right. So I'm at the Chinese financial institution. I'll start first.
Okay.
But no, I think that this speaks to a broader issue. I think that as part of any effective BSA AML program, you do need to track emerging regulatory risks. And for any bank that has a strong presence in the Chinese market, this is certainly a risk that could pose significant BSA AML sanctions and ultimately franchise operational risk. So it's something that needs to be tracked. And I do have some recommendations in terms of best practices on how to track this risk. But one thing to be very sensitive to is that we don't know what the restrictions under the Hong Kong Autonomy Act are going to look like. This was specifically it has been specifically called out there would be a denial of services to some foreign financial institutions. There is an assumption that those foreign financial institutions will be Chinese banks. We don't know who those are necessarily yet. So I think that what's important for banks to do at this juncture is to really understand what their vulnerabilities here. So they really should, and they should do this at any point that you have an emerging regulatory risk such as this, that could directly impact your business. You should perform an impact analysis. Specifically with respect to this regulation, one thing I recommend is that you actually segment out and identify your customers that have a nexus to the Chinese government or not Chinese public figures. And you could segment those out and be aware of how much of your book could potentially be in jeopardy. And also another thing that you should consider as part of this is what your standpoint on China and Hong Kong's country risk is too, ensuring that they are afforded the right risk level in your customer risk rating methodology, in your AML transaction monitoring methodology, and all your BSA AML models. So I think that this emerging risk typology like this is something that should trigger a reassessment of country risk as well as an impact analysis.
Yeah, I just want to make sure, because I'm not sure if everyone on the call, is really involved in sanctions. I know these people are maybe, in the AML world. So just want to make sure that everyone is aware of this Hong Kong Autonomy Act and what it is. So basically, on August 7th, the Treasury sanctioned 11 individuals. The Treasury Department sanctioned 11 individuals that they have deemed to be involved in undermining Hong Kong's autonomy. And this was under President Trump's executive order on Hong Kong normalization, which was signed on July 17th. So that's the result of the Hong Kong Autonomy Act. So yeah, I mean, I think that's what a lot of the banks that we have spoken to, that's what they're doing, kind of assessing the nexus to the Chinese PEPs, who the PEPs may be. Unfortunately, a lot of the Chinese banks, their senior members are PEPs. They are tied to the government. So it is interesting. It's going to be very interesting to see how this affects these Chinese banks that the Treasury Department has already come out and said they will sanction, the ones that are materially contributed to the significant transactions with these individuals. So don't know. I don't think anyone at this point knows what that means. But I think the plan is by October they'll come out with more individuals to sanction, as well as banks or foreign financial institutions that are involved with these individuals will be also sanctioned. So it's kind of up in the air. Everyone's kind of scrambling, but yeah, I mean that's unfortunately where we are right now.
That's unfortunate. As if our lives aren't easy, right? Just add more challenges on top.
Yeah, and unfortunately, I mean, because of how the political landscape is right now, and the election coming up in November, what I'm hearing from the industry is that depending on I guess the popularity of the Trump administration and how that goes towards the election, there may be additional sanctions against China to kind of show that we are tough on China. So no one knows at this point how this is going to all play out.
More to come. Get out and vote in November, right? Okay, so we're going to skip to the next page real quick because we do. Here you go, Matt. Okay, so I'll take this. So we need to do a quick poll. There's the last one. If you could answer, my institution's AML program work has been increasing, decreasing, or unchanged. And as before, we need the participants to answer these questions so that we could assign proper CPE credits for all. Matt, how many more seconds before we could close the poll?
Let's wrap this up. It looks like we are at that magic number there.
Oh, jeez.
Well, geez. Yeah.
Well, definitely not decreasing. So we know that.
And on top of the challenges from COVID, pandemic, work from home, and everything else too. It's getting tough for everyone. Okay, so can we switch the next and final question? So we wanted to pivot a little bit. So when talking about correspondent banking, the natural partner to correspondent banking is trade finance, which is a business that many of the international banks are engaged in. So with that, Kevin, if I could ask, can you share with the audience some of the challenges posed by correspondent banking and the trade finance in your institution?
What are not the challenges?
You got 5 minutes, Kevin.
Yeah.
Look,
Look, as I think Bill mentioned earlier, unfortunately, a lot of this is manual. You know, you have to look at the papers, you have to look at the bill of ladings, you have to look at, you know, the items that are being sold and bought, and try to find out, you know, does all that make sense? You know, outside of screening all of those parties that are also listed on those documents, right? Because that's also a manual process that you have to go through. But you have to have a process, a risk-based process in place to say, hey, you know, are we going to look at every single one of these transactions that come through? And when we do, you know, what are the minimum requirements? You know, what are the details of information that you're going to look at and compare to, and also document that and have kind of like a sort of like a mini database on your side to kind of track the pricing, you know, because not all the pricing is readily available on the internet, unfortunately. So you're gonna have to demonstrate to the regulators when they come in that I've compared the price of whatever, and this kind of matches my historical prices that I've used at our bank. And because of that, we felt comfortable accepting this transaction. So a lot of it is documentation. It's tedious. It's not fun, but you have to do it. And you just have to make sure that you're following your process and have a sufficient QC process to kind of, you know, go over that.
Yeah, I think there's a lot that can be said about this. So you kind of opened a Pandora's box here. So with respect to trade finance, I think that, as Kevin rightfully pointed out, it is a documentary business. There certainly are a lot of trade finance red flags and risk typologies that we don't have enough time to necessarily get into, but obviously the over-under invoicing, do the counterparties make sense? Is this their line of business? I mean, you have to delve as deep as to looking into the shipment routes to ensure that there's not transshipment through a sanctioned country. So there is a lot that only the documents can tell you. And so to that extent, if you're talking about trade finance as a product of your own institution, you'd be looking to first line defense controls as well as whatever layer of oversight you have over that. So many institutions have a first line defense control with some sort of compliance oversight and testing, or some sort of or a manual review process where the trade finance transactions and the trade finance documents are reviewed by compliance professionals. So yeah, it's a very hard risk to manage, and there's a lot that can go wrong. Especially, I mean, we're talking about a live environment. Imagine what could be wrong in a look-back environment, because then you'll be looking for the price of widgets in 2016, and so the publicly available information there might not be still in the public domain. So it's definitely very difficult, and there are no I wish I could say there was a hard, fast, automated solution to make our lives a lot easier, but it really comes down to how well you know your customers, their counterparties, and the due diligence that you perform on the representations in that document.
It's surprising in this modern era with all this technology and AI and tools that are available to us that trade finance still is a stick in our sides, and it still remains very manual in nature. Have you seen any technologies or vendor approaches that kind of relieve some of the pressures, or is it still very much manual in your institution as well?
So in my experience, it has been largely manual. There have been solutions in terms of databases that help you with tracking pricing, as well as we have used have used certain government intel databases to talk about trade routes. And the appropriateness, does it make sense? For example, would it make sense to source livestock from Siberia? Obviously not. But like certain financial intelligence and market intel like that, you can have some vendors have offered repositories that help us with those types of things. And obviously you have resources that are very much used in the sanctions space for vessel tracking. So there are resources available, but there is not really that there's not really any vendor that has that silver bullet that we're looking for. It's really all about it's really about due diligence, and many firms, and the firms that I've been at, have augmented their standard due diligence resources, which are largely dependent upon the public domain, by subscribing to some of these third-party vendors that offer some deeper dive into either regional jurisdictional databases or corporate formation databases.
And that takes us to the top of the hour. And Bill, Kevin, Jonathan, wanted to thank you for this really entertaining and involving conversations about correspondent banking and also trade finance as well towards the end. Just wanted to thank the audience for their participation and also answering the CPE questions from New York and from each one of our homes. Be safe, and thank you for participating in this session.
Thanks, guys.
Thank you.
Thanks.
It was fun.